presentation. My name is Kira Francetic, and I'm the Marketing Associate here at Richmond Brothers. We are extremely happy to have you listening today, and we're definitely looking forward to sharing some very important information with you. Today presenting, we will have Dan Vredeveld, an advisor here at Richmond Brothers, as well as Matt Kerfman, our Senior Vice President. First of all, I want to start off with a couple of disclosures that we, of course, have to share with you to make sure to keep our regulators and attorneys happy. And with that, I'd like to go ahead and hand it over to Dan to get us started.
Well, thank you very much, Kira. And again, thank all of you for listening in today. Got a lot of things we wanted to cover with you, and we hope that you can take something away from this and maybe educate you a little bit more. And you know, one of the things we wanted to do today is just give you an idea of what some of the things the you know, the big analysts that are out there, what they're kind of looking at, and what they use to get an idea of what to expect in the years to come. And you know, it's also some of the things that we look at when we do a lot of your planning and allocations in your portfolios. So the first thing we're going to do today is just talk a little bit about the S&P 500 and putting that into perspective, but not just the S&P 500. There's a few other indexes we're going to cover as well. Then we'll talk about some of the factors that affected the stock market last year. And then Matt will jump on and start talking about the U.S. economy last year and then what we're kind of thinking could happen in 2015. Now, first of all, when you turn on the news, you probably see almost everywhere, you know, the news people talking about the S&P 500. The S&P 500 did this, the S&P 500 did that, and really the S&P 500 last year made about an 11.4% return, so not a very bad year at all. Wasn't quite as good as 2013 was, but still a very good year nonetheless. And so you may be wondering, all right, why didn't my portfolio beat the index, or you know, why didn't I do as well as the index? And in reality, you don't want to be comparing your portfolio to the index, or any index for that matter. There's a lot of diversification issues with the S&P 500 and other indexes. They also tend to be more risky than what most of our clients are willing to take. And so that's why you really shouldn't be looking at these indexes to compare your portfolio to. Some other questions you may have, you know, are we at all-time highs for the stock market, or are we due for a major correction coming up here? So these are sorts of things we'll be covering tonight, or in this presentation for you. What we wanted to show you is this beautiful color-coded graph, and this basically just shows you how some of the major indexes have done since 2007. And you know, 2014, a few things to note. We had a couple indexes that did really well. We're looking at publicly traded REITs, as well as the S&P 500 Growth Fund. But on the other end of the spectrum, emerging markets and international funds really were at the very bottom. They got hit the hardest. And so I wanted to look at some of those here a little bit more in detail over the last few years as well. You go back to 2009, emerging markets were, and actually emerging markets and international funds were near the very top for 2009. Fast forward 2 years, 2011, they were right at the very bottom. And then you also have the example of the publicly traded REITs. 2011, 2012, they did really well, dropped back down in 2013, and then came right back up last year. And what we want to show you is, you know, you can't just throw a dart at a board and hope to get the best results, the best indexes, because one year an index might do well, the next year it may not. And so you really have to do a lot of research and a lot of analysis to figure out what is the best option for you and your portfolio. And that's what we do here at Richmond Brothers. What we want to show you as well is a diversified portfolio. So if you combine some of these indexes into a diversified portfolio, how would have that done? And you'll see here that with a diversified portfolio, you're never the very best return, but you're also never the worst return either. And so having a diversified portfolio definitely helps iron out some of the ups and downs that you would see from any one of these indexes. And you know, a lot of research is required to figure out what is the best allocation for you in your portfolio. And really what you want to take away from this is that you don't want to compare your portfolio to any given index. The goal is to be diversified, which will help reduce some of that roller coaster ride that we would have if you were all in any one of these indexes. Fast forward to this next slide, we wanted to show you some disclosures here. Basically, we had just talked about several indexes, and the big thing about indexes is you can't invest in them directly. It's just a group of companies, and so this is just letting you know you can't invest in them, and this is the rate of return that these indexes had over the last 7 years or so. And then the next thing we want to get into are some of the factors that affected the stock market in 2014. And you know, going back to the S&P 500 again, we've got the a little bit more detailed performance of it. 11.39% was the overall return for the S&P 500 last year. But from what you can tell here, it was anything but smooth. There were many dips along the way, and there were about 4 major ones. And so we wanted to kind of cover those with you. And I'm sure you all remember some of the issues that led up to some of these dips. But back in January, one of the issues that we had was emerging markets starting to sell off, and people were panicking, so the rest of the market sort of got hit too. And then we had another dip in June, in July timeframe. That was when the Feds were just talking about raising interest rates. They weren't necessarily going to do it, but there was talk about it, and people panicked and sold off at that point in time. Another big dip in September-October timeframe had to do with Ebola, and Europe was going through a bit of a crisis as well, and so there was some panicking going on because of that. And I'm sure most of you remember the last dip we saw here had to do with oil prices. So we'll kind of cover these a little bit more in detail as we move forward. But what we're seeing here, and one thing to look at, is with each one of these dips, very quickly the market came right back up again. And that's telling us that the fundamentals are still solid. And going forward, we may still see dips, but the key is to not panic about those dips. One of the fundamentals, speaking of which, that we look at has to do with employment and job creation. Back in 2008 and 2009, the United States lost about 8.8 million jobs. Huge amount. Had a huge impact, as you all probably remember. Since then, not only have we recovered those 8.8 million jobs, but we've also had jobs gained on top of that. In fact, since the end of the recession, about 10.9 million jobs were created, which is great because it helps drive the economy. And I'm sure some of you may have listened to this presentation a year ago, and we had talked about job creation then. The concern at that point in time had to do with a lot of the jobs being created were some of the low-income, retail, restaurant sort of jobs. But this year has proven that most of the jobs coming back now are the highly skilled, highly paying positions, things like IT, business, finance, manufacturing, all jobs that really help drive the economy. And the other thing we wanted to show you has to do with the number of people looking for jobs versus actual job openings. And that's what this chart here on the lower right shows you, the ratio of unemployed to jobs opening. And basically, if you go back to 2009, the peak of the recession, there were about 6 or 7 people looking for jobs for every job opening that there was. So there was a lot of competition going on, and employers had the ability to be very selective with who they hired. Over time, that's slowly declined, and we're actually at just under 2 people looking for jobs for every job opening. That's a very good market for those looking for jobs because there's a lot less competition going on there. We had talked a few minutes ago about one of the dips that we saw had to do with oil prices. And back in June of last year, the national average was $3.77 a gallon. By the end of the year, it got down to $2.63. And you compare all of that to back in 2008 when the national average was $4.11. And I don't know about any of you, but even recently I've seen it even lower than $2 a gallon. So things are improving on that front dramatically. And the reason why that's important to us is because when people buy gas, if they can spend less money on gas, that allows them to save their money and spend it in other areas that really help drive the economy. So this will be something we keep watching going forward here. Another fundamental that we look at has to do with the amount of money that companies are making right now. And we're at record levels still. And even recently, I'm sure a lot of you have seen Apple. They posted their quarterly earnings, and they actually made more money than any company or any person has ever made in the history of mankind. And so that's just a good marker that things are improving when it comes to companies and profits and those sorts of things. And the reason why that's important is because companies, as they get more money coming in, it allows them to hire more people, expand, mergers and acquisitions, those sorts of things that really help drive the economy. And we actually think this is going to be a big factor that comes into play here in 2015. One of the other fundamentals we look at has to do with interest rates. I'm sure most of you remember back in the 80s, you could go out and get a CD paying more than 10%. But at the same time, mortgages were really expensive as well. And that was a good time for savings. Since the recession, though, we've been in a spending period. And that's exactly what the government's wanted, and that's why they've lowered interest rates. They want to penalize people for trying to save money and try to push them into spending money. And that's what we've kind of seen here. Since June of 2008, rates have been next to 0%. And they still are. But if you recall from one of the previous slides, we saw a dip back in June of last year because there was talks about interest rates going up. A lot of panicking going on. But I will tell you that just because interest rates go up in the future, which they will, we just don't know exactly when. Some analysts are predicting maybe by the end of this year we could start seeing interest rates going up. We don't think it'll happen before their big meeting, though, in April. But one of the things that we've seen historically is that not always does the market go down when interest rates go up. And we've got some examples of that here. Basically in 1986, rates went up, and then the market also grew 34.7%. 1988, the market grew 41.9%. 1999, 11.3%, and then 2004, 37.2%. So not always does rising interest rates mean the market will go down. And these are just some examples to prove that. And one of the reasons why we think that that may not be the case here has to do with a quote that Thomas Lee wrote from J.P. Morgan Chase. He basically said, historically, bull markets lasting at least 4 years since 1897 have only ended with a recession. That is, they typically do not end just because everyone is too bullish. And what that really is telling us is anytime we've been in a bull market or a very positive market for 4 years or more, and it's ended, it hasn't ended just because. There were reasons for the fact that the market has ended. And the fundamentals are still doing really well. And so we're not really thinking that we're at the end of a bull market era. And now I will let Matt jump on the line, and he'll start talking to you about the U.S. economy last year.
Thanks, Dan, and thank all of you for listening. Just to kind of circle back a little bit on some of the points Dan discussed, what we're trying to do is point out what are some things we've seen in 2014, what sort of trends are developing, how should we apply that to your portfolio, what are you seeing, what are we seeing, and then how do we take that information and move into 2015 and then make decisions, obviously, with our crystal ball. So as far as the U.S. economy goes in 2016, 2014 rather. Once I get through that, I'll talk about some of our forecasts and our thoughts going forward into the year. So a few more trends that we did some research on just to see, are things moving forward? Are they stagnating? Are they moving back? Household service of debt ratio, and really that's basically home net worth for this category at the bottom. You see your household net worth. It kind of looks at home values. It looks at, are we back at work? It looks at, do consumers have money in their bank accounts? So you can see obviously a building chart on the bottom, and household net worth has actually increased quite dramatically since the recession, and certainly well ahead of where it was actually before the recession began. When you look at the debt service ratio and you kind of see that roller coaster that peaked in the fourth quarter of 2007, that 13.2% that you see at the very top of the chart, that is basically debt service as a percentage of disposable net income. So basically, as that percentage comes down, that means we have less debt as a society relative to the income that we have, which means it's more sustainable. And the happier and healthier consumers are financially, better the economy does. You may recall from previous sessions we've spoken about consumer spending, consumer confidence, for example. That drives 2/3 of our economic growth. And so while the consumer is doing well, typically so goes the market and also the economy. Another item that we wanted to look at has to do with federal debt. Since we looked at personal debt, and this is obviously a trend that is slowing down, but it doesn't seem to be getting better quite yet. If you look all the way to the right of this chart, you can look in 2015, we're at 74%. And so 2024, it's projected to be at 77.2. So those are basically looking at the total debt as a percentage of GDP, and GDP is gross domestic product, so the total value of goods and services that we put out in this country. You know, if you kind of look back to the beginning of this chart back in the 40s on the very left, what that is that's a period that's kind of following World War II, and we basically grew our way out of debt. We did not reduce the federal deficit, but the economy expanded so rapidly. So to compare, what that would mean is if you had a ton of debt as a consumer, rather than paying off your debt, you just went out and instead of making 50 grand a year, you found a job making 150 grand a year, and you grew your way out because you had that much more in assets. How much debt is too much for the economy to be sustainable and growing and moving forward? You know, unfortunately, there's no consensus there, but if we use some common sense, you know, you certainly can't have debt that's approaching your level of income, and that is definitely not sustainable over time. We surmise that whether it's over 5, 10, or 20 years, ultimately the federal government will correct that through increased taxes. So that's certainly something to consider as we look at portfolios and think about Roth IRAs and life insurance and estate planning. In spite of federal debt, we are still seeing the U.S. economy expand. So when you look at the two shaded areas, the light blue shaded areas here, the one on the left, what we're really basically looking at is the leading economic indicators. And so there's 10 of them, and this is charting those indicators. And typically, when those indicators show positive or green on this chart, that's when the economy's been doing well. And then right where the first dip goes down before you get to the blue shaded region on the left-hand side, those are periods of recession. So what's basically going on is you see that the leading indicators for a couple of quarters or months leading up to the recession, they were never positive, and so that's certainly a sign we can look at. Same thing in the recent Great Recession, if you look to the middle of the chart. Again, they started negative, they started to recover, but then they obviously went down considerably. Go to the far right, and this is basically where we're at now. So you don't see periods where you have strong leading economic indicators and then moving into recession. So I think that's an important thing to basically keep in mind. And so as you look at the economic recovery, do we think it remains strong? You know, our argument using some of this information would be yes. I mentioned a little bit ago consumer sentiment, and so that's a study that's actually done through the University of Michigan here locally for those of us that live in Michigan. How we feel about the economy sounds corny, but it's actually very important, and in essence it becomes a self-fulfilling prophecy. When you think about why do consumers feel good, you see on the far right, we've certainly been increasing in consumer confidence since recession. But just look more recently, Dan talked about cheaper gas prices, and I think at the end of the year it was $2.63 a gallon. Driving out to work today, I think I saw $1.99 a gallon for regular. So cheaper fuel is, the less money I have to spend on gas, the more confident I am about having more disposable income to choose how I want to spend it. And Dan also mentioned better job prospects. I think that's certainly a factor. And again, if more consumers are working, we have more income. That drives consumer confidence and again, becomes a self-fulfilling prophecy. As consumer confidence does continue to escalate and get higher and higher over time, I'm reminded of a quote by the famous investor Warren Buffett. And he says, "Be fearful when others are greedy and be greedy when others are fearful." So if we see consumer confidence keep spiking and getting to all-time highs, usually there's not too long after that you start to see things slip back the other direction. So when everyone else is greedy, that's when we want to actually be fearful, meaning should we be making changes to get more conservative in your portfolios. Another factor just to kind of touch on is inflation. CPI is the Consumer Price Index, and so you have headline CPI, which is the gold or yellow graph here, and you see that tends to move around quite a bit more than the blue line. Headline CPI basically includes food and energy, and so that's probably a more practical measure of inflation and are things increasing in price. But they actually strip out for core CPI food and energy prices because those are incredibly volatile. They're not saying that food and energy are not important to us, but what they're trying to do is look at a more consistent long-term trend. But you really see the same picture here, and so you don't see rising inflation. I don't see that as a huge penalty to consumers. Costs rising so rapidly that it's eating up our disposable income. So I think that's an important factor, especially as Dan talked about rising interest rates. Does that mean we're going to go into inflationary periods and so on? When you look at what is the Federal Reserve's target long term, it's somewhere between 3 and 3.5%. So we're certainly below that figure now, but I think holding steady, and that actually is a good sign. So now that we've touched a little bit on 2014 and kind of what have we seen in the last year, I'm going to use some of that information and then try to look at the 2015 forecast. And what I always like to say is only look to your past if it can benefit your future. So we actually use some of the information and the trends that we're seeing out there to hopefully predict and make accurate assessments for how do we want to be invested in your portfolios. We've typically shown a slide here. You don't need to see all the names, but it's all the major firms: Oppenheimer, Bank of America, UBS Capital, Goldman Sachs, Barclays. Kind of what are their price targets for the SP 500 for the full year 2015. When you look at the average, it's just above 2,200. Recently, the SP 500, to give you some perspective, is right around 2,000 points. So that would be just north of 7%. At Richmond Brothers, we think we're going to continue to have a volatile year, bigger and bigger swings with ups and downs, but we think when the year is all said and done, we should be somewhere between that 6 and 9% figure as far as broad market exposure. That should give you some indication that we do hope to have positive returns, even though there'll be likely some hiccups throughout the year. So just kind of keep that in mind. And I think it is possible the further we come along in recovery from the recession that these swings get bigger and bigger. So I think we had a 7 or 8% swing in the fall on the broad markets before it recovered. I think it's certainly not out of the question that we could continue to see those, if not, as high as 10% swings and still actually recover and grow from that. Continuing forward, if you look at the Federal Reserve, Dan talked about, had a chart on the federal funds short-term rate. And what that means to all of us as individuals is that dictates why we can't earn anything on money markets, on savings accounts, on CDs, for example. Over time, if the Fed funds increases the short-term rate, that should be a benefactor to us that are actually good savers and have money in the bank and can get CDs and money markets and all of these things. When it's at 0.13, you can see on the 2014 column at the very bottom, that's what it's been for over 6 years. It was on Dan's chart. It's projected, these are just forecasts, but projected that there are going to be increases throughout the year in 2015. but going from 0.13 to 1.13 is certainly nothing to write home about. I think as long as the economy continues to recover, I think the Federal Reserve will do slow and moderate increases, and we'll have to see if geopolitical tensions, things like Europe and Russia, if that all of a sudden weighs very heavily on the U.S. at some point. Eventually, we're becoming more of a global economy, and I certainly think there's a trickle-back effect there. Another chart I wanted to show just for informational purposes is basically the S&P 500 Composite, and kind of along the point to Dan's question at the beginning, were our dangers of all-time highs. You see articles that say the market just hit its all-time high. Should we be afraid? Should we be scared? If you look back to October 9th of 2007, and I looked at the Dow Jones and the S&P 500, but basically in 2007, the Dow Jones hit its all-time high of 14,164. If you look at December 26th of 2014, so 7 years later, the Dow Jones peaked at actually 18,154. We're currently hovering around 17,000 to 17,500, so we've come down from that peak. But if you look over that whole period of time, that's actually just a 4% annual rate of return. So we definitely need to try to get higher than that, and that's where having hopefully a diversified portfolio focusing on dividends and growth while having some guarantees like fixed indexed annuities, for example, we think blend together really well. If you look at this chart, the biggest thing is when you have flat periods like from 1900 to 1924, you had a peak, then we had the Great Recession, and then you had another flat period in the 30s to 48. But after those flat periods, we actually have historically shown pretty impressive periods of growth. So I think that's at least an indicator to keep in mind. Only look to your past if it can benefit your future. The question of are stocks overvalued? One of the terms that you see out there if you read any financial news is PE ratios, price to earnings ratios. And that's really just a measure of the earnings of the companies in the S&P 500 relative to their share prices. And what this table is trying to point out is on the very far right at the very top of the chart, you see the forward PE, and it says equals 16.2 times. So that at the end of the year is the forward PE ratio of the S&P 500. Historically, that number is around 15% as an average. So what I would gather from this chart that we've put together here is, are stocks overvalued? I guess what I would say is stocks may not be at a bargain, but when you look at all their asset classes, we actually think that stocks have a better value than those other asset classes, and we think in 2015 stocks should still outperform cash, bonds, and even inflation. So that's why we have a little heavier exposure to stocks and equities, if you will, in your portfolio. When you look at the bull market and look at the S&P 500 and say, okay, it's near all-time highs, what I wanted to show you is actually the chart on the right here, the one that says S&P 500 near all-time highs. Don't be too scared, if you will, that markets are pushing to all-time highs. All-time highs are not that far ahead of where they were in 2007, so really we're still in a recovery, and hopefully we're moving into expansion now. If you look at the 2009 to present period, which is the blue graph on the far right here, and you see the number 78%, so that's looking at since recession, the S&P 500 has been within 5% of its all-time highs 78% of all trading days. So to put some perspective to that, there's about 250 trading days in a year, and so that means on 200 out of those 250 trading days, we have continued to be within 5% of the all-time highs of the market. So it's certainly a case for the bulls, and that I think recovery and expansion could continue. The other thing Dan mentioned on his 2014 chart for the S&P 500 is looking at, oops, sorry, I went back one too many there, is looking at the intra-year decline. So when the market has a dip because oil prices are all over the place, or we have emerging market crisis, we have all sorts of things that happened last year for those 3 or 4 major market dips. Is that okay, and is that a sign that things are starting to turn around? What we're trying to show you here, there's a lot of data here going back to 1980, but it's okay to dip. What I wanted to point out on the very far right, you see the year 2014 in yellow, and the number is 11. So the return on the S&P 500 was about 11% for the year. I think it was 11.39 on Dan's chart. There were dips in the year. Below that year, you can see there's a -7 of -7%, and yet the market still ended positive. So when you look all the way back since 1980, so the last 35 years, average intra-year dips have been around 14.2%. But if you look, 27 out of those 35 years have still had annual returns that were positive, which is every year above the line there. So I think that's certainly something to kind of keep in mind as you think about, are we too hot? Is the market too high? That sort of thing moving into 2015. Outside of the U.S., when you look at the MSCI, that's the emerging markets, and then you have the Europe index. So look at the emerging markets, and their PE ratios are on the very bottom of this. So they're at 11 times. In Europe, they're at 14. So I think there may be some undervaluations over there. We're not ready to jump into that yet, but those are certainly trends that we are comparing relative to what the S&P 500, which is just U.S. corporations. So just something we're going to keep an eye on, but we'd prefer to stay focused a little more heavily inside of the U.S. if I had to use my crystal ball for 2015. Something else that's kind of out there is when you look at what economies, what countries have stable interest rates, and should we be looking at bonds in those countries rather than in countries where we have potentially rising interest rate cycle ahead of us like the U.S. So kind of in the middle of the table, under the interest rate stable area, there's two countries, Australia and Canada. So I more wanted to point that out, that not every nation is in the same position as the U.S., just like every nation is not in the same position as Europe. And so we do want to pay attention to those trends, and as we look for opportunities, see if those are places that we want to deposit or place funds on your behalf. So in summary, you have three things that can happen. You can have stagnation and we move backwards. You could have moderate growth, or you can have expansion. And so those are really the three paths. So, do we think we're going to have rapid expansion? If I had to say, I would say probably not. I'd say it's a low likelihood. Do we think we're going to have moderate growth this year? I think that's probably where we'll fall. It's kind of right in the middle. We don't expect stagnation. While we do think there will be dips and swings in the market, in your portfolios, we think that we'll be positive as we move forward throughout the year. And so that's why we've been more careful to choose holdings that have for specific growth. So, for example, technology or pharmaceutical. So even if the market stagnates or is flat, we definitely have some growth prospects for holdings, and it's a big part of your portfolio. So I think the important takeaway from all of this is that there is no one single solution. You can't obviously invest in an individual index like Dan was talking about. Those are just to give you a broad measure of how our company's performing, and hopefully in years where the indexes are performing well, we're doing well for your portfolios. In addition, that makes us all feel good. We're all making money. I think the trend is that we want to continue to look for good as far as holdings in the U.S. equities, and that's where we think we'll actually get our growth. We are paying attention to the overseas areas where we will probably continue to see some flops. And earlier I mentioned estate planning with life insurance and Roth IRAs and other things we should be looking at to combat long-term potential future increases in taxes. That's also part of the portfolio management. So we do think there'll be a positive year in 2015. That's what our crystal ball says, and I know crystal balls have broken before, but I think you will see that some of the signs from our presentation are that we are still moving in a positive direction. And I think most important is to look at the consumer, how we're doing with our disposable income, how we're feeling, and I think that will tend to drive further growth, at least as we look for the next 12 months. So thank you so much for tuning in. I'm going to pass it back to Kira for closing remarks, and we appreciate having the opportunity to serve you. Make it a great start to 2015. And Kira, back to you.
Thanks so much, Matt, and thank you, Dan. We really appreciate you taking the time to go through that with us. This does conclude today's presentation. If you have any questions at all, please feel free to contact us directly. We'd be very happy to hear from you. As you'll see on your screen, you can send us an email at questions@richmondbrothers.com or give us a call at 536-5000. For more information and timely updates, please follow us on social media. Thanks so much again for tuning in. Make it a great day.